Hi, I'm Jeff Dewees. I'm the Chief Investment Officer at Auric Capital Partners. Today we got news from Jerome Powell and the Federal Reserve that they're going to lower interest rates by 50 basis points. It's the first time in 4 years that the Fed has lowered interest rates, so it's big news today. We're pretty excited about it. They also come out with the dot plot. The dot plot has the rate at the end of this year down at 4.5% and next year at 3.5%. For those of you that don't know, the dot plot is a chart that records each Fed official's projection. There are 19 officials, and all those are taken into account, and they create a dot plot, and then we figure out what rates the Fed is anticipated to move towards. So we will see if that stays on course. The Fed had to balance a couple of things. They have a dual mandate, is what they call it. Max employment is number one. This number has moved over 4% now and seems to have the Fed's full focus. Stable prices is number two. This can read as inflation. The Fed target for inflation is about 2%, and right now it's down to the mid-2s. So for now, they are able to shift their attention away from this mandate and direct it all onto max employment. What does this mean for markets? Well, the bond markets and stock markets price themselves on expectations. So today's entire cut was already priced into the bond market. For example, the 2-year Treasury held steady around 3.5%, and the 10-year actually went up a little at 3.65%. This is important because mortgages usually move more in relation to the 10-year than the Fed funds rate. So we should not expect a 50 basis point move down in mortgage rates overnight. It may move down in the near future over expectations of further rate cuts, but we will see if that happens. If it does, mortgage rates coming down under 6% would be something to watch, because right now they're slightly above. It may free up some supply as current homeowners have been reluctant to give up their existing sub 4% mortgage rates. If supply does expand meaningfully, it also may mean a decrease in housing prices. So we're moving back to a more normal interest rate curve, which is in general good. A normal curve means that shorter term interest rates are lower than long-term interest rates, which makes sense. If you're going to loan out money, you would expect to get a higher rate of return on the longer loan than the shorter loan. So right now, the 3-month is at 4.6, the 2 years at 3.5, the 10 years at 3.65, and the 30 years is at 4. So you can see that for the most part, it's a normal sloping yield curve, except for that outlier in the 3-month. And that's where the Fed funds rate actually has the most impact. Today, the 3-month was down about 12 basis points. So we're getting there, but the yield curve can normalize a couple of different ways. Short-term rates can come way down, or longer-term interest rates can go way up. Or usually it's some combination of the two. For now, the Fed is going to keep a watchful eye on the unemployment rate while hoping that inflation does not reignite with the new dovish policy. We'll be watching too. So stay calm, stay diversified, and stay positive. From all of us at Auric Capital, we wish you all a great day.